In this lesson, we will make a review of the Module 5 via a case study scenario. This case study demonstrates how lawyers can systematically apply financial statement analysis to detect red flags, uncover fraud, and support legal arguments across acquisition disputes, contract litigation, and fraud investigations. Let's start with the scenario. TechFlow Solutions, Inc. A technology consulting firm is the subject of an acquisition dispute. The buyer alleges that the seller manipulated financial statements to inflate the purchase price. Lawyers must analyze the company's financials from 2021-2023 to detect issues and build their case. Analyzing the income statements of TechFlow Solutions, Inc. reveals potential red flags: a 45% revenue spike in Q3 2022 and 52% in Q4 2022. Unusual for a mature business, while operating expenses dropped during the same period. Additionally, gross margin improved drastically from 39% to 52%. Such simultaneous revenue growth, expense reduction, and margin improvement without significant operational changes are statistically improbable and could indicate financial statement manipulation aimed at inflating the company's valuation. The analysis of TechFlow Solutions, Inc.'s revenue recognition practices highlights a significant red flag. Days sales outstanding, DSO, increased sharply from 13.5 days in Q1 2021 to 36.5 days in Q4 2023. Despite fluctuating revenue, this rapid rise in DSO suggests potential issues with premature revenue recognition or collection delays, which could indicate aggressive accounting practices or operational inefficiencies. Such trends warrant further investigation to ensure compliance with revenue recognition standards and to assess the company's financial health. TechFlow Solutions, Inc.'s financials reveal a significant red flag. The COGS ratio dropped from 65% in Q1 2021 to 48% in Q4 2022, while operating expenses as a percentage of revenue also fell, leading to a gross margin increase from 35% to 52%. These sudden changes may indicate expense misclassification to artificially inflate profits. Such practices can distort financial transparency, raising concerns about compliance with accounting standards and the accuracy of reported profitability. Further investigation is essential to ensure proper expense allocation. TechFlow Solutions, Inc. experienced a gross margin jump from 35% in Q1 2021 to 52% in Q4 2022, surpassing the industry benchmark by 14%. This 13-point increase is highly suspicious without clear operational changes or justification. Such a significant deviation from industry norms raises concerns about potential financial manipulation, such as misclassification of expenses or aggressive accounting practices. Further scrutiny is necessary to determine whether the reported margins accurately reflect the company's operational performance. TechFlow Solutions, Inc. shows a consistent but small difference between operating income and net income, with a 2% gap in Q3 2022 and 1% in Q4 2022. While such differences are expected, large or erratic gaps could signal hidden financing costs, unusual expenses, or one-off items that may distort financial transparency. In legal contexts, these metrics are critical for assessing the company's operational performance versus its overall profitability, helping to uncover potential irregularities that could impact court proceedings. TechFlow Solutions, Inc. Its balance sheet reveals concerning trends. Accounts receivable grew 300%, far outpacing revenue growth, raising potential red flags of channel stuffing or collection issues. Additionally, working capital spiked by 163% in Q4 2022 before declining, suggesting possible short-term financial manipulation or operational inefficiencies. These anomalies, combined with a significant increase in total assets and equity, warrant further investigation to ensure the accuracy of financial reporting and compliance with accounting standards. TechFlow Solutions, Inc.'s working capital analysis reveals significant fluctuations, with a 163% spike in Q4 2022, followed by a 15% decline by Q4 2023. The baseline working capital in 2021 was $2,263,578, while the closing figure in Q4 2023 reached $2,633,707, resulting in a $370,129 adjustment owed by the buyer to the seller. Such artificial inflation of working capital can lead to post-closing disputes and price adjustments in sale and purchase agreements, SPAs, emphasizing the need for precise definitions and clear reconciliation processes to avoid legal conflicts. In the next lesson, we will apply this scenario to the last topics of Module 5, like current ratio and quick ratio in covenant analysis and cash flow versus profit. Which one matters in court?